All right. So before I get started, I just want to say that this presentation focuses completely on annuities, and it is a general overview of the types and abilities and capabilities of the annuity product. And so I believe that annuities are a safe investment, and I also think that, not that I think, I also know that annuities can uh, support retirement goals and educational goals and also goals for building generational wealth in our community. So without further ado, I am going to share my screen and then we will begin. Okay. Okay. So here we go. So once again, my name is Max Wiltz, and the name of the agency is River Rock Financial Group. This presentation is what is an annuity and why you need one now, presented by yours truly. Any examples in this presentation are just that, examples and illustrations, and not representative of any particular investment. Please consult your financial tax expert or advisor. I am a financial consultant, financial advisor in the realm of insurance. I do know a little bit about taxes. However, please consult your tax advisor when moving forward. All right, so the thing about annuities that is specific to this particular product is that they are a part of the insurance family. And what makes insurance great is because the rich and wealthy have used insurance for centuries to build generational wealth through several key factors: tax deferred growth of their money, guaranteed interest rates, and accumulation on their money, income stream creation through insurance, probate avoidance, which means when the time comes, your beneficiaries will not have to deal with the probate court in this particular area. Now, other things like real estate could be subject to probate conditions, but not in insurance. You totally bypass probate, especially with annuities. And then educational funding. Educational funding can be used specifically with the insurance products, and this one in particular, annuities. For centuries, oops, centuries, individuals, rich and wealthy individuals who know the power of accumulation of money through insurance, and in this case, annuities, have realized and utilized the ability to gather enormous amounts of wealth and pass those amounts down to their beneficiaries at the same time, utilizing it in their lifetime. A lot of people think that insurance is just for death, and it's not, especially in the 21st century where you have living benefits. And annuities are really supercharged living benefits because it can generate passive income streams while you're alive. And they can also be passed down in several situations. When the New World, when people were sailing to the Americas and their ships needed to be uh, financially secured, that was the beginning of the modern insurance product. So people, sailors, conquistadors, explorers sailing from Europe into what we now know as the Americas insured their ships against loss through insurance. When kings and queens and knights and all the different people in the medieval times needed to cover themselves against loss, the people that made the things that they used, armor, uh, silverware, houses, those craftsmen, the people that were building the things, created their own insurance products. In Europe in the 1500s, in the 15th and 16th century, when fire was prevalent, when people's houses would catch on fire, especially rich and wealthy people, had fire insurance. What that meant was they would spread the risk around because they knew they would have fires. This was just a common thing because at that time they weren't really aware of how to stop preventing fires. So they would insure their houses and their properties and their businesses. And so when it burned down, they would just get a check from the insurance company and rebuild it. Hammurabi, who was the leader of the Babylonian Empire eons ago, would require merchants, people that traded, bankers, um, he required them to have insurance on their products so they could cover their loss. Because Hammurabi knew one thing is that his subjects, whether rich or poor, did not want to lose the things they had. So he required them to insure their products. And so historically, insurance has been used as an effective tool to increase, generate, create, and pass down wealth, simultaneously in avoiding certain tax mechanisms or tax structures. So you can build your wealth tax deferred with insurance, specifically annuities, but really any insurance product. But today we want to focus on annuities. So please, if you have any questions, please drop them in the chat and I will address those at the end. Okay, so what is an annuity? Term annuity means that there's a contract between a person, a client, or a group of clients. Yes, it could be a group, where you pay in a premium or premiums, plural, and then those premiums are then accumulated through interest through some investment vehicle. And after a certain amount of time, then those premiums are paid back in the form of, with interest, payback plus interest in the form of income. So you invest your funds in the annuity, the insurance carrier then invest. So you invested with the insurance carrier. They then invest that money in some type of index fund, mutual fund, some type of market apparatus, or some type of structure, of stock, bond, and then they guarantee X amount of interest on your money. And then after a certain amount of time, then you are able to then realize an income. There are two phases of an annuity. One is the accumulation phase. And what that means simply is that when the accumulation phase means that you are now placing premiums, contributions into the annuity contract. I'm going to continue to use the word contract. So you place money into the annuity and it accumulates. Your premium plus interest is accumulating at the same time. That's phase one. Phase two is the annuitization phase, which means at a certain time in the future, then you start to realize an income from those contributions back to you in the form of that particular stream that you choose. It could be monthly, it could be quarterly, it could be yearly, etc. Okay, so I hope I explained that pretty well. So that's what an annuity is. It is basic format. Okay. All right. So here are some annuity basics. These are the things that I really like about annuities. First of all, there are no medical exams to start an annuity. So unlike other insurance products, you don't have to have a medical exam. There are no medical questions. So you pretty much decide what type of budget you have, whether it's $100 a month, $200 a month, $50,000 one-time premium, whatever your budget can handle. That's what it decides how the annuity gets started. Okay, so there are no medical exams, there are no medical questions. All annuities accumulate value with interest to the owner, all of them. And that's the thing that a lot of people don't understand. There are other products, but with annuities, it's pretty much straightforward. There's no ambiguity, there's no confusion. The annuity says the annuity carrier says we're going to guarantee you X amount of interest on your premiums, and then they give you a illustration of how those premiums are going to be affected and accumulate over time. Most annuity products, the interest rates are guaranteed starting at 3%, which is better than bank rates in savings accounts. A lot of people put their money in savings accounts, not realizing that the bank is taking your money, putting it in the market, realizing 10, 20, 30% returns, and then giving you back 1 or 2%, maybe 3, maybe. But annuities guarantee anywhere from 3 to 10%. Now, there are some annuity products that go a little bit over 10%, but we're going to stay in the ballpark of 3 to 10% for this particular presentation. Okay. So 3% is pretty good, guaranteed over time. All right. And I'm going to show you an example here at the end of this presentation. Clients can this is another beautiful thing about annuities. Clients can transfer funds or roll over funds from different accounts. So, for example, if you have $50,000 in a IRA or some other type of account, retirement account, and it's subject to loss. So the annuity is subject to, I mean, not annuity, I'm sorry. Certain vehicles are subject to loss. So certain financial products, I'm going to pick on the 401k, can lose value. Now, I'm not saying there's anything bad about 401ks, but what I am saying is that with an annuity, you're not going to lose your initial investment. So if you put $10,000 in an annuity for $100 a month or $200 a month, you're not going to lose your initial investment. It's not going to go below that. And so you can roll funds over from those accounts that you don't have to do it all. You could, some people do 50%, some people do 100%. It just depends on that person's tolerance. And so you can roll those funds over and then appreciate and realize gains, consistent gains. The thing about an annuity is consistent. It's not going to lose. Okay. And which leads you to my next point. Annuities have what's known as in the stock world, stop losses. So they stop your losses at 0. So, for example, if an annuity is guaranteeing you 3% and you have an indexed annuity, which we'll talk about here in a second, and you're gaining, but the market loses, you're not going to, it's going to stop your, what they call zero floor. It's going to stop at 0. It's not going to, you may not realize a gain, but you're not going to go below your, whatever your initial investment. You're not going to lose your initial investment. We're going to keep saying that. And then also, of course, an annuity is an excellent retirement supplement. So if you have, let's just speak it. If you have $1 million and you put it in an annuity, yes, people do have annuities that they put $1 million in or $500,000 in. It can gain interest, which is what rich and wealthy people do. They take part of their money, put them in annuities, and those annuities gain interest, and then they wait 5 or 10 years, and then they start to realize the income from that annuity plus interest. I cannot stress enough the interest function of an annuity. All right, here's some other annuity options. You have the basic options are immediate annuity, which means one-time lump sum premium, and usually those income streams back to the owner start in 30 days. So what happens with a one-time lump sum premium, with an immediate annuity, is that they place, usually they have premium limit or premium limits. So basically, you can put $5,000 or $10,000 in, or 20,000, or 30,000, 100,000, or 250,000, and then in 30 days, the owner of the annuity has the option of choosing an income stream from that particular annuity. So that's a great vehicle, a great product. And then you have the deferred annuity, which means the client pays a premium over time, which I'll show you here in a minute. The client pays a premium over time, which is the accumulation phase. Now, notice the immediate annuity does not have an accumulation phase because it's immediate. The deferred annuity is great because you can place up to $500,000, $1 million, and it can accumulate. It can just keep accumulating interest. And then the client determines when they want their income stream to start. And they can wait a month, they can do it quarterly, they can do it yearly, which also gives the annuity continuous interest earning power. It's a powerful product. All right. Then you have the fixed annuity. Okay. So a fixed annuity guarantees you an interest rate, in many cases 3 to 10%. We've said that already. All annuities are hedges against inflation. So they hedge against inflation, which means the more you let it accumulate, inflation goes up. You may have 2 or 3 different retirement funds, and the annuity acts as another additional stream of income or hedge against that inflation. Retirement income supplement, it's low risk. So fixed annuity means I know how much. So with the fixed annuity, if they say we're going to guarantee you 5% or 5.6% or 5.75, whatever they say at the time of annuity inception, at the time you sign that paperwork, that's the income, that's the fixed interest rate you're going to get no matter what. It cannot go up, it cannot go down. They guarantee you 3 to 5%. I mean, whatever the percentage is that you sign that day, and you defer the taxes on the accumulation. You cannot get taxed on the money that is accumulated in the annuity. Again, the death benefit avoids probate. So, for example, if the annuitant is receiving an income for 40 years, and when they transition, whatever's left in that annuity goes directly to their beneficiary. Can't be touched. Amazing. Then you have the immediate income annuities, which I just touched on, but I'm going to go into a little bit more detail. Minimum amounts are required for immediate income annuities. All right. And of course, the lower amount of premium, the lower the amount of income to the annuitant. I suggest at least $50,000 of immediate income annuity premium, because once you do an illustration, it's going to show you how much money you will start receiving in 30 days. Now, you don't have to take it every month. You can let it accumulate, take it every 3 months, let it accumulate, take it every 3 months. You can keep that process going. Okay. But the waiting period for immediate income annuities is 30 days. Okay. You have 3 payout options: the lifetime of the annuitant, and then, of course, at the end, the beneficiary receives what's left. The joint survivor, 2 people receiving an income, one person transitions, the other person continues to receive the annuity payments until they transition. Then annuity stops. If it's something left over, the beneficiary receive it. And then the period is certain. So the period certain is great because you can say, okay, once this is over, the annuity is going to run out in 20 years. So they can actually plan out a 20-year annuity, a 30-year annuity, a 40-year annuity, and then it will zero out at that time. So there's no beneficiary in period certain. Okay. Now you have the indexed annuities, which are great because this is for people who have a little bit higher risk tolerance, and they say, I have $100,000 that I want to put into an annuity, and I wanted to utilize the indexes of the markets around the world. And so, of course, you have the S&P 500, the NASDAQ, uh, and so on and so forth. There's several different indexes that you can attach the annuity to, and it guarantees you interest rates based on the indexes that you're following or that your annuity is following. And they put caps on those rates. So those rates are pretty high. So you're talking about 7, 8, 9, 10, and sometimes a little bit higher, 13, 14, 15%. You participate in the market index, up and down, the roller coaster of the markets or the roller coaster of the indexes. But then you still don't lose your initial investment. Okay. So it stops. If it starts losing money, it's not gonna. Now you may lose some index money, but you're not gonna go below the interest rate that you've been guaranteed. Okay. There are several different variations that insurance carriers have created to make it enticing and beneficial to the owners. And now we move to variable annuities. All right. So variable annuity is a little bit higher risk, which means the annuitant chooses different variable indexes, bonds, rents, commercial rents, or it could be residential rents. So if you have a company that does rental houses, they create stock or index, and then the annuity can utilize part of that. They can be placed in what we call sub accounts. And so your principal plus those sub accounts, the interest earned on those sub accounts, create or combine to create an income to the owner. So you defer. So this is a type of deferred annuity, which means you are now participating in the markets, plural, and you also may be participating in indexes. Okay, which is great because now you're able to participate in the ups of the market and sometimes the downs, right? But the thing about it is you get to choose your risk tolerance. So if it's moderate, high, low, even if it's a low variable annuity, then you still get to participate in several different sub accounts. Okay, if that makes sense. So sub accounts attach themselves to different indexes and funds, mutual funds, stocks, bonds, etc. It's a great thing for people that, like I said, if you have 401k with 100,000 or 200 or $1 million, and you want to take $250,000 and roll it into a deferred annuity, and then a deferred variable annuity, then you're able to participate in the market just like you would be invested in stocks. The only difference is you don't have to sit there and look at your stock portfolio every day. They'll let you know. Okay, you don't have to pick and choose. You can just set it and let it go. All right. So hopefully I've explained the annuity options. Now it's time to look at a real life example of what an annuity can do, right? This is pretty straightforward, a very safe annuity. This carrier that I'm going to highlight in this particular presentation, Royal Neighbors, they do a great job. They have some very straightforward products. And I like to work with them, and they like to work with me. So I do have other carriers, but in this particular scenario, we're going to talk about annuities with this particular carrier. Okay, so you have a multi-year guaranteed annuity. Again, there are different variations of annuities. Okay, so this is now there are several carriers that create multi-year guaranteed annuities. It's a one lump sum premium, so it's basically the immediate annuity, right? However, it's deferred. So what they did was they took the deferred annuity and then combined it with the one lump sum feature to defer your taxes until you decide to start taking the income. Beautiful product. And what this does is it guarantees your interest rates for 3, 5, or 10 years. And at the end of that 3, 5, or 10 years, then you're able to start receiving an income. Excellent product for people who don't want to stretch the annuity out. You can say, okay, at the end of 10 years, whatever interest rate you guarantee me, then I'm going to start receiving income. Okay. This is a single premium immediate annuity, not so there's no 3, 5, or 10 year period, one time premium. For this, in this particular case, they want a $5,000 minimum to start receiving a fixed income. Again, with the single premium, you cannot change the amount of fixed interest that you receive. $5,000 minimum. Now, I cannot tell you right now, I'm not going to speculate, but 5,000 over, I don't know, 10, 20 years. It's not a lot, but it is an income stream. Okay. But this is a single premium. If you don't want to think about 3 or 5 years, if you just want to say, okay, I got $50,000 I'm going to put in this, what I call an SPIA, single premium annuity, and $50,000, give me the illustration, and let's see how much money I'm going to receive in retirement income or income stream. And by the way, guys, you don't have to have retired to receive an income from an annuity. Okay, so let me straighten that out. You can still be working, put the annuity in, but most people do that because they want to have something when you retire, which is a smart move. And then you have what's known as the flexible premium deferred, which again is a deferred annuity, but the premium is flexible. The beauty of this particular product is that in the example I'm going to show you, the premium is flexible. So the premium has what's known as a floor, which means in this particular product, it's $100. So you have to have pay a monthly premium of at least $100 a month. All right. Now, here's the thing about this. It can go all the way up to $25,000 a year. So this particular product, this particular annuity, $100 a month is $1,200 a year, right? So, but let's say, for example, you say, okay, I got a new job, I got a raise, I would like to contribute more to my annuity. You can actually raise it to accumulate to a $25,000 a year premium. Every year you can put $25,000 a year into this particular uh, annuity, and then at year 10, this thing is going to be, it's guaranteed at right now, guaranteed at 3%. So just think about if you had $500 a month or $1,000 a month or $300 a month or $200 a month, and you want to put in this product in this particular annuity, it's going to generate at least 3% on your money every year. Excellent, excellent product. All right, so I've said a lot. I've said a lot, but here is an actual example of what I just talked about, which is a premium deferred, flexible premium deferred annuity. Flexible premium with a floor of at least $100, which is deferred. So here we go. This is an actual example of one I did. So this particular annuity, the monthly premium is $100. The guarantee rate is 3%. It's never going to go below 3%. So guaranteeing her 3% on her money of $100 a month, $1,200 a year. And so you see here in the illustration that was done, you see here that the interest rate is 3%. The premium every year is $1,200. And if you do the math, which I did, the cash rent, the account value actually increases 3% every year. Non-guaranteed, same thing because it's guaranteed versus non-guaranteed. It's 3%. She could put $200 a month and it's gonna double. She could put $250. She could do what she could do whatever number she wants to in place of this annuity. It's gonna guarantee 3%. Okay, which means her account value continues to increase. And even let's say, for example, she got to year 11, which is the magic number. At year 11, she can choose to just pull all her money out if she like to, or she could just let it keep going. But again, this is the minimum 3% in this particular annuity. As you can see, at year 20, at least $32,000. Just imagine at year 20, her child is trying to go to school and they need, or trade school, or want to buy a car, whatever the case is, she'll have that money in that account. At year 30, almost 60 grand, at least 60 grand, right? Because again, if it's just $100 a month, it's guaranteeing at least at $58,000. What could she do with that money, right? Just imagine what could happen. All right, so to my point, why do you need an annuity? Just like in the previous example, $100 a month, $125 a month, $150 a month can help pay for so much in the future. Herein lies the reasoning behind this presentation. At least $100 a month in the future, now these are just examples, in the future could do a lot. It can help pay for a child's car repairs, rainy day fund, repairs on a home. It could be a down payment on a vacation home. It could do so much. So that's why you need an annuity right now. The best time to buy an annuity is now, not later. Okay. And hopefully this has been beneficial to those watching. And the biggest thing is that annuities are a way to create and generate wealth, and to also make sure those that rely on you and yourself have something in the future that's guaranteed. Okay. Here are some products that other products that I offer. Feel free to screenshot if you like. At the top, here are the life insurance products in the top row. On the bottom left are the annuities that I talked about, the flexible premium, the multi-year guarantee, and the single premium. And then there is additional coverage riders that you can utilize to attach to the annuity to increase the value, right? The benefits of all this can be always be increased, right? So feel free to screenshot any of those. I'm going to check the chat for questions. I don't see any right now. All right. So thank you for watching. Thank you for taking the time out of your Saturday and being here with me to explain why you need an annuity, what an annuity is. Feel free to reach out to me on Instagram at River Rock Financial Group LLC or Facebook at River Rock Financial Group LLC. My email is riverrockfinancialgroupllc@gmail.com. And once again, my name is Max Wiltz. I am your financial professional. Please don't hesitate to reach out with any questions, concerns, or to get started in annuities or any other life insurance or wealth building accumulating product. I am available for questions and or answers. So, does anybody have any questions? All right. So, if there's no questions, then I appreciate your time and hopefully we'll be in touch.